Okay, so we talked about how as an employee, you pay payroll taxes and your employer pays payroll taxes. When you're self-employed, you are both of those people, right? You are the employer and you're the employee. So you are responsible for 100% of that. All right, and the way that we're going to calculate that is you're going to figure out what is subject to self-employment tax. Not all income is subject to self-employment tax. It's only income generated from your work, essentially. And so that would be the net income from a Schedule C. It would be flow through from a pass through if you're acting like a general partner, if you're active in it, flow through ordinary income, and any guaranteed payments. So guaranteed payments for a partnership are like a salary. So, and they don't keep taxes out of them. All right. So you add all those up, take them times 0.9235, and then you would calculate your tax. So on your resource sheet, what you're going to use is that front side, upper left, the self-employment tax information. Okay. All right, so Holden single reported 197,000 net income from his Schedule C. What do we know about that 197,000? It is definitely going to be subject. We would include that in gross income. It would be subject to income tax. Was his revenue 197,000? No, it was probably quite a bit higher, right? Because this is net, which means this is revenue less expenses or deductions, whatever gives us the net. And that is what is subject to self-employment tax. Okay. I don't know why I give this speech, but some of you will take revenue and calculate self-employment tax on that instead of subtracting the expenses related and calculating self-employment tax based on the net. Okay. All right, he had no other earned income. Calculate his self-employment tax and his deduction for AGI for self-employment taxes paid. Okay, so we're going to start with 197,000. And we're going to multiply that by 0.9235. Do you need to memorize that number? No, it's right there on your resource sheet. Gives us 181,920, 9.5. Okay, self-employment tax has two components. We have Medicare and Social Security. If we calculate Medicare first, there's no cap. So we would just take that number times 0.029. Do we need to memorize 0.029? No, it is on your resource sheet. 5276. That's the Medicare portion. All right, what about Social Security? Are we going to take 181,929.5 times 0.124? No, why? It's a max of 160,200. Do you need to memorize any of those numbers? No. Okay, so the maximum Social Security anyone should have to pay in 2023 is $19,865. We hit that, add those two numbers together, you get 25,141. This is his SE tax. So great news if you're self-employed. you have to pay income tax on the 197,000. And also on your tax return, we're going to add 25,141 in. Where does that go in the formula? Yeah, so you calculate your income tax liability, and then you're going to add that to it as well, and then subtract credits and prepayments. So that is how self-employed individuals pay and calculate essentially their payroll taxes. Okay, so if we calculate, I could also ask you to calculate AGI. I asked for the deduction, but let's just go ahead and calculate AGI. We would have his net schedule C of 197. And what else? Okay, studied this for the test. Partial list of 4 AGI deductions. Half of the self-employment taxes, you get a deduction to calculate your income. So if we take this times 1/2, we get 1/2 SE tax. We have deduction of 12,571. Okay, so now that you know how to calculate this, I won't tell you, hey, you need to calculate self-employment tax and deduct half of it. I might just say, you know what, Holden had net income of 197,000. What's his AGI? And you have to know and remember, if you're dealing with a self-employed individual, you have to calculate their self-employment tax so that you can deduct half of it to calculate AGI. Yes, Connor.
So we deduct half, but we still have the full amount.
Yeah, so it's saving us on our income tax return, income tax calculation, but then we still have to pay that full amount. Any idea why we get to deduct half of it?
To encourage self-employed people.
I wouldn't say encourage. Yes, Dottie?
That's the employer's half.
That's the employer's half. So when your employer is paying payroll taxes, that's an expense of doing business. They get to deduct those payroll taxes in full. So by you deducting half, you're deducting the employer's spot, and it's then equitable. Yes. If, let's say, Holden has employees, right, working for his business, he may, in this number, and some of his expenses might be wages and payroll taxes for his employees, deducting his share of it. So I don't know if he's got employees or not. We don't have enough information. Okay, questions? So if I had you go all the way to calculate tax liability or sorry, tax refund or tax due, then you would have to remember to add this in after you calculate the tax liability, because he owes that. Okay. If you have a self-employed individual and all they are is self-employed, then the calculation's pretty easy. But you do have individuals who maybe have a job and they're self-employed. Okay, and now that means is we just have to watch out and make sure that they're not paying more in Social Security tax than they should have to. Because whether you are an employee or an employer, whether you're an employee or you're self-employed, the max income that you should have to pay Social Security tax on is 160,200. And once you reach that, you can stop. All right, so the limit is applied to salary first. Then we would use whatever's left of our limit to calculate our self-employment tax. So Tyler made 99,000 working for KPMG for part of 2023 before deciding to open his own CPA firm. His firm had net income of 98,000 during 2023. Calculate Tyler's SE tax. The total amount that you should have to pay Social Security tax on is 160,200. Tyler is already paying Social Security tax on wages of 99,000. Leaving only 61,200 you should have to pay Social Security tax on. Okay. Does he have self-employment income? Yes, of 98,000. What's our first step when we have self-employment income? That's when we have our tax calculated. Times 0.9235. $90,503. For Medicare, we'll multiply that times 0.029. 2,625. And what are we going to multiply times 124? 61,200. $7,589. Okay, so Tyler has total self-employment tax of $10,214. If I ask you to calculate Tyler's AGI, how would we do that? Okay, you want to multiply that times 1/2? 5,107. What do you want to do with that? What should be included in Tyler's gross income? Wages of 99,000. Net SE income of 98,000. And subtract 1/2 of the SE tax. 91,893. This is AGI. If I ask you to calculate taxable income, what would you consider next?
Well,
Okay, specifically, standard or itemized. You don't have any information about itemized, so we'd figure out what a standard deduction is. That would give us taxable income. Then we could calculate tax liability. After we have tax liability, we would add in an additional 10,214 and go on from there. So it's always important to keep in mind big picture. Basically, I told you all we're doing all semester is just adding to the income tax formula. So this is just a piece of it. Yes, Connor.
So if his wages were greater than the social security max.
Correct. Yep. He would have already maxed it out. And he would owe no self-employment social security tax. All right, any questions? One of the things I do want to make sure that we make a note of here is his net income from self-employment. That's all subject to income tax. The number after the 0.9235, that's what is subject to Medicare and other payroll things that we're going to talk about. Okay. Sometimes I will see students try to sneak this number into AGI as the income from self-employment. That is incorrect. We don't get this little bit of deduction for income tax purposes. Okay. All right, flip your resource sheet over. Next up, we're going to talk about the additional Medicare tax on earned income. Where does that fit in your income tax formula? Other taxes. All right, both, if you look at your resource sheet, you'll see the additional Medicare tax on earned income and the additional Medicare tax on unearned income. Both of those are taxes that came about when President Obama passed the Affordable Care Act, and they got that through, requiring health insurance for everybody and subsidizing those that can't afford health insurance is expensive, right? So we had to come up with some revenue producing provisions. And one of the ways, or two of the ways, were these additional taxes. These are taxes on wealthier individuals, help cover those costs. So the additional Medicare tax on earned income. What is earned income? Yes, your efforts, your physical or mental efforts. So that would be wages or net self-employment income. So to calculate this, we have to add in wages with it as well. The tax is 0.9%. So don't forget that point. And it's also on your resource sheet. I'm going to keep hammering this because on your test, a lot of you missed something that was on the resource sheet, like clearly written out there. So 0.9% on there. This is calculated from the combined wages and net self-employment income reported on the return. It's combined for spouses. All right, which means I failed to mention something back here on self-employment taxes. This is calculated per person. Okay, so if you have a wife who's self-employed and a husband who's self-employed, they will do their calculation of self-employment tax completely separately. And they both have the $106,200 limit. We don't combine them at all. They would each do their own separate calculation and attach to the return. All right. So if Holden happens to be married, his spouse would do a separate calculation. If they happen to make the exact same amount, you'd have 25,000 of your self-employment tax and 25,000 of their self-employment tax. So it's not at all combined. But when we get to the additional Medicare tax, we do combine all of that together. So we'll take one spouse's wages, maybe another spouse's self-employment, and add it together. You are not subject to this tax if those items combined together are less than 250,000 for married filing joint. For single or head of household, you're not subject to this tax until you get over 200,000, which is what makes this a tax on the wealthier individuals. Because you have to have those combined earned income over those amounts. If you are an employee who makes over 200,000, I hope you all have this problem in a few years. Your employer will withhold 0.9% on your wages over 200,000, and it's treated like a prepayment. Because you might think, well, I make 200,000, my spouse stays at home. We have less than the 250. I'm not going to be subject to this. You'll get it refunded to you whenever you file your tax return. Okay. It's just required to prepay it. That's that last item. All right. We used to do a calculation of this, but I've taken it out. So, I expect you to understand the fundamentals of who would be subject to this right here on your resource sheet. And I expect you to know where the tax would go, but I'm not going to ask you specifically to calculate it. Okay. So if I told you Holden had additional Medicare tax on earned income of $3,000, would you know where to put it in the formula? You do not get a 4 AGI deduction for half of this. Questions on the tax on earned income? All right, there's also the additional Medicare tax on unearned income. This one stings a little more for wealthy individuals. This is 3.8%, a lot bigger than 0.9%. Again, you're not subject to this until you exceed the same thresholds. And if you have no net investment income, you're not subject to this either, right? So it's 3.8% of the lesser of how much you exceed or your net investment income. So if your AGI is 100,000, this number here becomes 0. Therefore, you wouldn't be subject to the tax. So what is net investment income? This is generally the unearned income, the more passive income. So interest, dividends, annuities, rents, passive activity. So passive activity income is income generated that you don't materially participate in. Oh, wonderful. Hold on, we'll be back. There you go. Okay, so I believe last week, Matt was starting a business. He was looking for some funding. He's gonna run it all, manage it all. But AJ was looking for an investment. And so AJ was gonna put in $100,000. Okay, and maybe they're Matt 70% owner, AJ for his investment is a 30% owner. Okay, the first year it generates $100,000 profit of net income. Remember, 30% of that, 30,000 is going to be allocated to AJ. Did he materially participate in the business? Is he active? No. So for him, it would be considered passive. And could be, it would be included in this. And potentially, I mean, AJ's got a lot of money and he's got a lot, I mean, he's got all sorts of investments from other places. So that 30,000 could be subject to this tax when combined with everything else. Matt, on the other hand, he is actively involved in the day-to-day operations of the business. He has 70,000 allocated to him. What is the outcome of that? That is self-employment income. You're going to have to pay self-employment tax on that 70,000 and potentially pay 0.9% because it's earned income to you. Earned income to you, unearned income to AJ based on your level of involvement in the business. Does that make sense? Okay. Interest, there's really no way to make interest active unless you're a bank maybe, or dividends. Rent, unless you are a rental or unless you're a real estate professional, rent is always a passive unearned activity. So, okay, any questions on either of those two taxes? All right, the last, I mean, I guess we could put up here, this goes in other taxes as well. And the last other taxes we're going to talk about is the alternative minimum tax. Okay, I'm not going to spend a lot of time on this because I don't think you're going to be tested on it, but I want you to know that it exists and to make fun of Congress a little bit, okay? So there are those who believe that wealthy individuals do not pay enough income tax. Not illegally, but just legally. They invest wisely, they take advantage of, they buy a municipal bond, they take advantage of the preferential rates that we're talking about. Like, they're doing great tax planning. They're following the rules Congress passed, and now Congress is mad they're not paying enough tax. So instead of changing those rules, we will create an additional tax system, and you will calculate your tax under that. And if it's higher, you'll pay the alternative minimum tax as well. Okay, so the alternative minimum tax starts with taxable income, which you know how to calculate, and then it adjusts it for things that aren't allowed for AMT purposes that maybe are allowed, and vice versa. It has its own exemption, which is essentially like a standard deduction for the AMT. And then it's taxed at either 26 or 28%. You get a tentative minimum tax. So let's say you go through all of this calculation and you get $20,000 is your tentative minimum tax. If your regular tax liability is higher than that, then you just ignore all this. But if your regular tax liability came out to be only $8,000, guess what? You owe AMT tax of $12,000. And you would include that then with the other taxes. And that's how the AMT works. Again, generally only affects wealthier taxpayers. Questions? So it's possible I may tell you they calculated their tentative minimum tax was 20,000. Their tax liability, maybe you calculate or I give it to you as 8,000. What do you do with that? If the tentative minimum tax is higher, you add the difference to other taxes and they have to pay tax on it. All right, questions before I close this set of slides? All right, we'll move on to chapter 8, which is credits and payments, kind of talking about that area of the income tax formula. We haven't really talked about our calculated credits yet. Would you agree that's an accurate statement? There's a lot of people calculating credits on the exam. So I appreciate your enthusiasm to get going on it. So hopefully we'll be all on the same place today once we start calculating them. Went too far. There we go. All right, so we're going to be talking about the tax computation and credits. The first item that I want to talk about, and there's just one slide on this, and this is not the right slides. It's not the updated numbers. I bet I picked spring instead of fall. Sorry about that. We'll get there. The unfortunate thing is you have to start over. Doesn't take you back into the folder you're currently in. There we go. Okay, the first tax we're going to talk about, or really the only tax here, is the kiddie tax. Okay, and this is how you would calculate your tax liability if you were a dependent subject to the kiddie tax. Okay, so we have calculated how, or figured out how to calculate the dependent's standard deduction, but we've not calculated a dependent's tax liability. And it may be calculated exactly the same as you would do any individual. But if they have a significant amount of unearned income, which is, yeah, passive investment type income, then we have to calculate their tax liability differently, okay? This is going to apply to children who are 17 or younger, who are 18 or 19 to 23-year-old students who don't provide over half of their support with earned income. Okay, so you don't actually have to even be a dependent to be subject to the kiddie tax. If you are if you're providing over half of your own support with unearned income, you would still be subject to calculating the kiddie tax this way, even though you weren't a dependent. This way of calculating our tax is going to apply if our unearned income exceeds $2,500. If you look at the back side of your resource sheet, the upper left-hand column, it will tell you to calculate net unearned income. You'll take unearned income minus 1250 minus the greater of 1250 or itemized deductions that are allowed. I will tell you, we will never have itemized deductions related to it in this class. So that is unearned income minus 1250 minus 1250. When you add 1250 and 1250 together, you get 2,500. Okay, so that's where the 2,500 comes from. If your unearned income is less than 2,500, you're not subject to the kiddie tax. Your unearned income in excess of 2,500 is going to not be taxed at your marginal tax rate, but instead your parents' marginal tax rate. So why would we have this rule? It used to be that if you were 14 or younger than 14, you were subject to this. Okay, so if you are a or let's say you're a 12-year-old and you have investment income of $8,000, how is that possible? Lotus? There you go. Someone gave you a lot of money or gifts that have been invested for you. That could potentially, without this rule, or before we had this rule, this was a way for higher income individuals to shift income that's being taxed at 37 or back then 50% down to 10%. That's a good tax planning strategy, right? Save 50% on tax potentially. So Congress passed this rule that says, okay, you can go ahead and do that. But if you have a child under 14 who has significant amount of unearned income, they're going to pay tax at your rate. You're not shifting any tax burden. That makes sense, right? We can all get on board with that. As a 13-year-old, what kind of income could you possibly have? Maybe a little bit of earned income from like wages or babysitting or some self-employment type gigs. That would be it, but you wouldn't have other types of income. Well, then Congress decided that there was too much shifting going on after you reached the age of 14. So they changed it. I wrote an alarm, but it was the wrong time. Set an alarm for 1:10 p.m. Okay. Congress decided there was still too much income shifting. The problem is, though, is they did not change the definition of what is considered unearned income. So think about you at your age. Is there different types of income that you have that a 13-year-old might not have? Think about a 21-year-old or a 22-year-old college student. Might they have gambling income? Is that a wage or self-employment income? No. Guess what? Unearned income. We had a student who went on The Price is Right and won a trip to Nicaragua. Is that a wage? Is it self-employment income? No. Subject to the kiddie tax. Her winning a trip to Nicaragua, you going gambling and winning $1,000, is any of that income shifting from your parents? Not at all. Should that be subject to the kiddie tax? Not at all. If dad gives you $1 million and you invest it, sure, that should be subject to the kiddie tax. But this other type of income, guess what? Scholarships. If you have a taxable scholarship, is it a wage? Is it self-employment income? Potentially subject to the kiddie tax. It's ridiculous. This rule is ridiculous. The Professor Davis and I wrote a very impassioned paper about how ridiculous this was. And for the longest time, the IRS didn't really, their forms says it apply, their forms were entitled investment income, and they didn't use the term unearned income. So they didn't even realize that what the rule really entailed at that point. So there's a lot of stuff that could potentially be subject to kiddie tax that shouldn't be, but that's what the rule is. And I guess you guys are not of a strong lobbying group to get that changed. So it remains. Okay, so let's calculate this because you're going to have to do it on your homework. Jasmine is 21, claimed it as dependent on her parents' return. For 2023, Jasmine earned $3,000 from a part-time job. So that would be earned or unearned? Earned. And had $7,000 of interest income. Unearned. Jasmine's parents had taxable income for 2023 is $450,000, and they have no other dependents. What is Jasmine's income tax liability for 2023? Before we get there, what is Jasmine's AGI or gross income? 10,000. So we got the wages, 3,000. And we have the interest, 7,000. So her AGI and gross income are both 10,000. What comes after AGI? The standard deduction. What would Jasmine's standard deduction be? Not 13,850. Lotus? 3,400. Why? Yes, Jasmine is a dependent, so we have to use the dependent standard deduction rules, which is earned income plus 400. So that's our wages plus 400. So Jasmine's taxable income is 6,600. The next step is to calculate her tax liability. If she's not subject to the kiddie tax, what is it taxed at? 10%. She owes $660. Easy. Does it says that Jasmine is a dependent, which means she cannot provide over half of her own support, which means she didn't provide over half of her support with earned income, right? So she must be potentially subject to the kiddie tax. Does she have unearned income over 2,500? Yes. So to calculate the net unearned income, we're going to take 7,000. That was the interest. Less 2,500.
Awesome.
Minus. Yeah, you don't have to pay the kiddie tax if your unearned income is 2,500 or less. And you can get that from your resource sheet. Okay, so it says unearned income in excess is taxed at the parent's marginal tax rate. So of the 6,600, 4,500 is going to be taxed at what rate? 32%. How'd we get that? Married filing joint. 450,000 falls in the 32% bracket. So we're going to take 4,500 times 32%. That is 1,440. All right, how much taxable income does she have left? 2,100. And that's just taxed normal. So we take that times 10%. That's her marginal tax bracket. So $210. So instead of Jasmine owing $660, because she's subject to the kitty tax, she owes $1,650. Questions? Connor.
Why is it 10%?
You would just use the single table.
Oh.
So the first 11,000 would be 10%. If she had taxable income of, I don't know, 12,000, it would be, you just use the single table to calculate the tax. Good question. All right, what if, just get a new slide here. What if taxable income equals 5,000? And you do a calculation and net unearned income equals 5,600. What would we do then?
$3,100 is taxable, whatever the parents money right now.
This net unearned is already subtracting the 2,500. So her unearned income was 8,100. Okay, so we subtracted the 2,500 from that and we were left with 5,600. What would we do now? Should we do something like that? That's weird. No. This is just all taxed at parents' marginal tax rate. Okay, so don't create more taxable income than a person actually has. Okay, so back here, the net unearned income was less than taxable income. So we taxed a portion of it at the parent's marginal tax rate. The remaining was taxed just at her rate. But if you're in a situation where your net unearned income is more than your taxable income, then you would just tax all of the taxable income at the parent's marginal tax rate. It's possible for this to happen if you have a lot of unearned income and not very much earned income. Questions? You feel very confident about the kiddie tax? It's got an awful name. But. Okay, let's switch gears then and talk about a very hot button issue for the IRS. And that is whether someone is an employee or whether someone is an independent contractor. If you're an independent contractor, this is here in parentheses, that is referencing the independent contractor, okay? Independent contractors are self-employed, employees are not. So let's talk about the difference, and then we'll talk about why it really matters to the IRS in a little bit. All right, an employee is an individual whose duties are controlled by an employer. All right, Dr. Otero cannot just decide that next week she doesn't want to teach managerially anymore. Instead, she is going to teach how to properly train and take care of dogs. Would not be allowed. Okay. An employee works according to a regular schedule in return for a wage or salary in general. Okay. An independent contractor can have whatever schedule they want. Dr. Otero wants to teach a class on how to train dogs on Saturdays at 3. That's totally up to her. Independent contractor performs services for a fee, not a salary or a wage. They control the way the services are performed. And oftentimes the relationship with their client is temporary. Not always, but oftentimes it is. The IRS is going to look at behavioral controls. Who controls how the work is done, when? Financial controls. Who's responsible for paying the expenses? Who bears the risk of loss? If you guys don't pay your tuition, I still get paid, right? And the relationship of the parties. How do the parties perceive their relationship? It seems black and white, but in actuality, there is a lot of gray area in this. And so, depending on where you reside, you're going to be more aggressive one way or the other, whether you're the potential employee or the potential employer. So this is an act from an actual court case. The tax court looked at these facts and had to decide whether these attorneys were employees or independent contractors. So you guys all get to be the tax court today and see if you agree with what they came up with. Jeff operated a small law firm complete with 3 associate attorneys, a law clerk, and an office manager. Jeff preferred to hire his associate attorneys right out of school. Key terms of their service included the following. They were not required to work from the office or work set hours, nor were they required to account for their time. What does that sound like? An employee or an independent contractor? Independent contractor. They were not required to sign employment contracts or non-compete agreements. They were free to provide services elsewhere if they chose, though there was no evidence that they ever did so. Employee or independent contractor? Independent contractor. It would help our case that they were an independent contractor if they had looked for other employment. worked for other attorneys. They were referred cases by Jeff and were encouraged to find their own cases. As an incentive, they received half of the fees they collected on cases they generated, but only a third on cases referred to them by Jeff. What do we think? Kind of both. This part, encouraged to find their own cases, that would be independent contractor, referred cases by Jeff, that would be an indication of an employee. So we kind of have a mix there. Jeff recommended that the attorneys attend seminars, read certain articles, and attend one or two of his trials. Employee. He's dictating or trying to dictate what they should do. Jeff would often advance an attorney the expenses of litigation. If the case resulted in victory, Jeff would be reimbursed. If the case did not result in victory, Jeff bore the risk of loss. On cases where he advanced funds to an attorney, he required oral status updates. He wanted to know what was going on. Jeff provided to each attorney an office, furniture, janitorial services, and all the other benefits that come with having a cubicle. Employee. Okay, I will tell you that this is not to sway your decision, but this is not a like, let's make a list of both and whichever one has the most, that's what's going to win. Okay, so we can't do that. All right, do you know how you would rule if you were the tax court? How many say the attorneys were independent contractors? How many say employees? And there's a bunch of you not getting paid because you did not take a stance on this, right? Okay, the tax court agreed with most of you for sure. It's again, we have these not black and white cases. This one here was one of the items they really focused on. Who bears the risk of loss? Okay. The other thing we have to keep in mind that it's possible to be an independent contractor and to start off that way, but at some point the relationship crosses a line and you're no longer an independent contractor, you're really an employee. Okay, so let's think about Truman hiring a plumber. Okay. Some of you might have lived in a dorm that required extensive plumbing services, right? Truman has kind of two options here. They could call Service Express or I don't know, name of plumbing companies in Kirksville and have them come, bless you. They could have them come work on the issue. That would be an independent contractor, right? But they may also decide that we need a plumber pretty much here all the time because those college students are hard on things in the dorm, right? And so they may just hire someone at the physical plant full time, and that's all they do is plumbing stuff. So that's an example of where it kind of depends on what the situation is of whether you need someone as an employee or you want to do an independent contractor. Maybe we should hire an employee because we need the services so often, but we like the flexibility of being able to call multiple different plumbers whenever there's an emergency, right? If we have a plumber on staff, we can't expect him to work 24 hours. But if we just contract with an independent contractor, we can just call them whenever. If they're busy, we can call somebody else and so on. Okay. Why does this matter? We all pay taxes, right? Well, it matters because employees generally have a much higher compliance with the tax system, income tax system. Their employer is going to withhold income and payroll taxes. It is for sure going to get paid from reputable employers. And those employees are going to get a W-2. Many of you have gotten a W-2 before, right? What does a W-2 tell you? Tells you your wages you earned. So it's really easy. You just pull it right into your gross income. It tells you federal income tax that you've had withheld. So that's a prepayment. It tells you your Social Security tax and your Medicare tax you've paid, which you guys can all now go grab your W-2s and verify that it was 6.2% and 0.0145%, right? Should be. Any state income tax that was withheld, all that is taken care of by the employer, even though the employee paid it. Okay. If you are an employee and you have expenses related to your job, so if I were to buy expo markers, because there are never any in here, at this point in time, that is an unreimbursed, if Truma doesn't pay me for the expo markers, that is an unreimbursed business expense that an employee has. And currently not deductible. In 2026, those may come back as an itemized deduction. But right now, if you're an employee and your employer doesn't reimburse you, there's no tax benefit for you. You're just out of pocket that. All right, independent contractors, there is no withholding requirement. If you do plumbing work for me and you charge me $200, I pay you $200. You are supposed to pick that up on your Schedule C as self-employment income, or if you're in a partnership, you would do a 1065 and report that. You pay the income and self-employment taxes directly. And if you don't have prepayments through the year, as an employee, you have to make quarterly payments, which we'll talk about next week. There is a requirement for certain businesses. If you pay anyone for services more than $600, you do have to provide them a 1099. Now it's a 1099 NEC. Has anyone received a 1099 NEC? All right, my mom is often sending them out at the end of the year for anyone who did farm work for them more than $600. So farm labor, someone who put in a fence, someone who did bulldozing, those are all services provided. This 1099 NEC used to be the miscellaneous. That helps ensure compliance. Because guess who is really unlikely to report all of the income they earned and pay tax on it? Self-employed individuals. They have an extremely low compliance rate. So if you're the IRS, how would you like to have everybody classified? Employees. You want everybody to be employees. If you're a business, how do you want everybody classified? Independent contractor. Why? Two reasons.
You don't have to withhold or pay payroll tax.
You don't have to pay your share of payroll taxes. They're responsible for all of it. And you kind of alluded to the other part of it. The record keeping is much easier. If you have employees, you have to calculate payroll taxes and do withholding and remit that to the government lots of times throughout the year. Monthly, weekly, depending on how big of a payroll operation you have. It increases your cost immensely because you have to either pay somebody to do payroll for you, or you have to have someone to do payroll. If everybody's an independent contractor, all you have to do is just write a check, $200. Here you go. If you are the person working, being the employee or the independent contractor, what would you prefer?
I mean, it's easier if you're an employee for your employer to do all the work when it is.
Yeah, and then you only have to pay half of the payroll taxes, right? So it's cheaper for you. So most people would like to be employees. I guess the only reason that you wouldn't want to be an employee is because you are planning to lie on your taxes, and being self-employed potentially makes that easier. But that is a really bad reason to want to do that. All right, so because of this, because businesses want people to be independent contractors, and independent contractors often lie on their tax returns or don't file, the IRS is very aggressive with this, and there's a lot of audits in this area. If you have someone who is actually an employee, but you're choosing to treat them as an independent contractor, that can have huge ramifications. Have to pay all the taxes that you owe, plus penalties and interest for it. So, okay, any questions on employees versus independent contractors? Okay, well, we'll stop here for today and pick up with credits on Tuesday.